Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to Merryn Talks Your Money, the personal finance edition of Merryn Talks Money. In these bonus podcasts, and they're a very good bonus, we talk about the best strategies for making the most of your money. I'm Merryn Somerset Webb, and with me, senior reporter and money distilled author John Stepek.
Hi, Mel.
Hi, John. Okay, so this week we're answering a question from Kewin, who says he is a millennial. As a reminder, that is anyone born between 1981 and 1996. And it's about him benefiting. Profiting is the wrong word. Benefiting from the great wealth transfer. Now, what is the great wealth transfer? It's this idea that the older generation are one of the richest generations ever, and their money is gradually going to filter down. These are Vanguard numbers. By 2030, a projected $18.3 trillion will be transferred globally, and by 2050, Vanguard expects $7 trillion to pass between generations in the UK alone. So that's all about the aging population. It's about increased wealth concentration, and it's about these longer life expectancies that have allowed the older generation to build up these fairly massive fortunes, right? So we have this transfer. It's an extraordinary opportunity for inheritors and I suppose for financial advisors as well along the way. It might be a challenge for older people to try and figure out how to do it. And it's a challenge, I guess, for everybody to figure out how to manage that money when it comes. And we all know the old stories about how generational wealth disappears, right? Somebody makes it, the next generation spends a lot of it, and by the third generation, it's basically all gone. I mean, in fact, Vanguard do have some research on this from the US that shows that as many of 90% of wealthy families have their wealth completely disappeared by the third generation down. So if you're getting this money, you really want to find a way to hang on to it, or at least manage it well, or even, spend it well. So here's the question. Kewin, and by the way, lucky Kewin, has inherited some money and is expecting to continue to inherit money in the nearest future. He wants to know what to do with it. So in his letter, it's a longer letter, he says, I don't want to just stick it in Bitcoin or gold. Fair. Or a generic S&P 500 tracker. I find it stressful as I worry I could lose it. You could. Or invest it unwisely. Also possible. Or have it wiped out by inflation. Also very, very possible. Kevin's got a good handle on the risks here. What are the best ways to get good, well-rounded advice at a low cost? Currently, TikTok is nudging me to a global tracker. Well, I mean, I guess you're getting very cheap advice from TikTok, whether it's well-rounded. I mean, I don't know about that. But your show makes me want to use an active manager. Okay, John, so I'm going to start here with our usual disclaimer. We are not accountants. We are not financial advisors. We are not fund managers. This is not financial advice. We do not know all the nuances of Kevin's financial situation, although we are already envious of him. I'm only 2 minutes into the podcast. We can give him some general knowledge that we hope will help inform him on decisions he'll want to make with his money. But actually, do you know what? Before we get on to Kewin, I wanted to start with Warren Buffett. Have you seen his letter?
Actually, no, I haven't. Not his latest.
Warren Buffett put out a letter on a press release, I guess you'd call it, from Berkshire Hathaway on Monday this week, in which he talks about how he's distributing his money and gifts he's making into his foundation, etc. But along the way, he talks. He's such an interesting man. He talks about his will and how it's written and his children. And he makes this, he's quite old, Father Time always wins, he says, but he can be fickle, indeed even unfair and even cruel, sometimes ending life at birth or soon thereafter, while at other times waiting a century or so before paying a visit. To date, I've been very lucky, but before long, he will get around to me. That would be a very sad day. His children are 71, 69, and 66. So when he talks about what he's given to his children, he doesn't want to create a dynasty, and his cornerstone of the whole thing is that wealthy parents should leave their children, and this is the key bit, should leave their children enough so they can do anything, but not enough that they can do nothing. I hope that's what Kewin is getting.
Unless his dad's Warren Buffett, I think there's probably no fear of that.
Yeah. Yeah, and the other, well, I think he's left his children are getting money in the tens of millions rather than the hundreds of millions. I think they already got 10 million from their mother, and I can't remember the details of what else he might give them. But again, they're not going to be rich, but they are going to have an insane amount of money at their fingertips to give us philanthropic gifts.
I mean, that's rich, and also, I mean, I do think that. I think Buffett that's very sensible and all the rest of it. At the same time, it's got the same sort of underlying tone as a lot of his other quotes, which is that out of the context, you can take them the wrong way. But I mean, for most people, leaving your kids tens of millions is enough to do nothing.
Very fair.
It's his particular realm of super billionaires that this is that this applies to. But it's a good concept.
Okay, so what do you think? What do you think, John, is enough to do anything but not nothing? What's enough?
It really does depend on your background, because of lifestyle inflation. I mean, at their level, the kinds of houses they'll be expecting to live in, the kinds of places they'll be expecting to go, the kind of lifestyle they're going to expect to have will require.
Although Buffett lives and as everyone always says, he lives in a relatively humble house.
Aye.
Driven past it myself on my visit to Omaha. Quite nice, actually. I mean, they always talk about it being very humble. It's actually very nice, but that's only because we're English and our houses are crap and their houses are big and nice. So, we drive past any old house in America, we think it's amazing. It doesn't necessarily
True, but
count.
Buffett is unusual. I mean, he's unusual in a lot of ways, and by no means remotely traditional either. I mean, my point is that the higher up in your social standing and your social status and I mean, one reason we've got all the problems at the moment, as Peter Turchin points out, is the idea of elite overproduction. And what it is you get an awful lot of kids who go to uni and whose parents owned a house when they were X age. And, you find that you think yourselves being in the middle class, you've probably got a middle class job, but you're hitting 40 and you're still living in a 1-bedroom flat with, a newborn baby or something like that. And by the standards of someone brought up in Easterhouse, say, you might be extremely wealthy, but you certainly can't do nothing. In fact, you feel as if you haven't got anything like the amount of money you need to live even a modest middle-class life. And I got a lot of sympathy with that person because it's absolutely true. So I just think that number, I don't think you can pull that number out of a hat without knowing about someone's background and what lifestyle expectations are.
All right. I just wanted a number from you.
Listen, John, God almighty.
Listen, I know the endless lecturing. Listen, everybody. Listen, I want you to send me in your number. What is the number that would make you feel that you could do anything? The number that would make you feel that you could choose any career, but you wouldn't necessarily do nothing. I'm really interested in this. I've got a number in my head.
I was just going to say, what's your number?
We will discuss this when the other numbers come in.
fair.
Send me your numbers and I will give you my number. Right. Now, there is one other thing that I want to read from this Buffett letter. I will. Kevin, I'm coming to you. I'm coming to you. But there's one thing he said that's so important, and this is not for Kevin. This is for the people who might leave money to Kevin. This is Buffett. I have one further suggestion for all parents, whether they are of modest or staggering wealth. When your children are mature, have them read your will before you sign it. Be sure each child understands both the logic for your decisions and the responsibilities they will encounter on your death. If any have questions or suggestions, listen carefully and adopt those found sensible. You don't want your children asking why when you are no longer able to respond. I think that is incredibly valuable advice. Incredible. And you've seen so many families driven apart by wills that they don't understand. Leave them confused, leave them angry, leave them jealous, leave them upset, leave them poorer than they expected to be, etc. And it's a terrible thing. So this, if you can do this in advance, this honesty between families, I think that's incredibly valuable. So much valuable advice from Warren over the years, but I think that one absolutely nails it. Right, Kevin, we are actually now going to pay you some minor attention. John, what should Kevin do?
He's right about not sticking it all into Bitcoin or gold, the generic S&P.
Although I will interrupt you there to say, look how well Charlie's bold strategy has done. That's back. Go read my newsletter from 2 weeks ago. Learn about how if you had both over the last little while, you would have done rather well. Of course, I entirely agree with John. You shouldn't go sticking it into both. Sorry, John, I interrupted you. Carry on.
It has done very well. No, I think, look, the thing he said at the start, like, we don't know the rest of his circumstances, and those actually really matter. So he needs to get an overall view of how much money he's already got invested, including in, I'm assuming, his auto-enrollment pension, see where all that is already allocated. And then if he's happy with that allocation as it stands, then just top that up with the money. But by the sounds of it, he probably hasn't thought about that yet. So I think what he first of all needs to do is look at, because I'm assuming he's got some savings. So where are those just now, Kevin? Are you happy with the way those are distributed? And if you're not, figure out how you do want to distribute it. And by that, I just mean what percentage you want in equities, what percentage you want in bonds, and what percentage you want in cash and gold, basically. And the other thing I would say there is he's a millennial, so he's still quite young. He's younger than me, he's younger than us. He should have a heavy weighting to equities, assuming that he's got a normal human being's risk appetite, because equities are the thing that do best in the long run, and they are the thing that should deliver a return above inflation as long as what's happened in the past 100 and odd years continues to happen. It's not advice, it's boring suggestions, but that's it. Where's your money now? Are you happy with where that is? Add to that. As long as the money's for the long term, I'm assuming it is. If it's for a house deposit, then obviously he needs to stick it in a cash savings account and wait till he's built up enough. But that doesn't sound like what it's for.
No, and I suppose the other thing we should say, again, it doesn't seem that this is Kevin, but if you haven't got 6 months worth of cash in an easy access account, you're not yet ready to invest at all. So I'm really hoping that Kevin is inheriting enough that the 6 months of cash are nothing to him, pennies, and he's got that already in a nice as higher interest instant access account as he can. That's just paying for your freedom.
And I mean, the
right?
other things he could look at is if he's got a mortgage and he wants the kind of certain amount of security that goes with having paid that down more than you need to. You could look at doing that. To me, a lot of the time, that's actually more a psychological choice. Certainly in the recent past, you've been able to get an investment return much better than the interest rate on your mortgage. At the same time, I remember James Ferguson once saying years and years ago that it's never a bad idea to pay down your mortgage. And I mean, in terms of the psychological impact, that's definitely I think that's a fair thing to say.
Yeah, I think it's the same with maxing out a pension quite early. Wouldn't it feel great to have put the maximum in for, say, 5 years or something and know that you've got a really, really good base, and if you don't contribute later, everything's going to be fine? So, that wrapper, that your mortgage wrapper, your pension wrapper, your ISA wrapper, having those all filled up sort of during those years of your late 20s, early 30s, so that you can then sit back and go, that's all done. My base financial security is assured.
Definitely.
And now I have much, much more financial freedom than I might have before. I really like that idea. But one of the things that he's really asking in this is, do I go passive or do I go active? Now, we've both written about this and talked about this a lot over the years. So if you listen to one of our roundup podcasts from last week, where we talk a lot about how expensive the US market is and about how over the long term, buying expensive is usually a bad idea and buying cheap is usually a good idea. One of the things that is assumed in that conversation is that if you believe that the US market is in a dangerous situation, you must also believe that passive investments are in a dangerous situation, in that the US now makes up a huge amount of the global indices, well over 60%, and the big tech stocks in the US make up a very high level of the US index. So if you're a passive investor, you'll be automatically holding a huge amount of the US and a huge amount of the very few giant tech stocks in the US.
Just for clarity here, we're using passive to mean a global tracker. Whereas obviously you could buy a passive fund that only invested in the FTSE 250, for example.
Absolutely. And
so we're not really talking about low cost versus high cost. We're literally talking about doing nothing but following the exact makeup of the global equity market index.
Yeah, which is one of the things that Kevin asked about. Should he buy one of these big Vanguard global trackers? And the answer is there's risk inherent in it.
Yeah.
So you can go passive, but if you're going to go passive, make sure that it's a much more diversified way of going passive. As John says, maybe you don't want that big global tracker. Maybe you want a bit of small cap UK. Maybe you want some large cap UK. Maybe you want some emerging markets, etc. But you want to, I would say, and again, not advice, you don't want to be too weighted to the expensive part of the global market over the next few years.
Yeah, I mean, I think that makes sense. Some of it also depends on your appetite for getting involved with your own asset allocation. And that then kind of boils down to your own personal tolerance and in your own judgment, your own ability to manage this stuff and make the effort. I mean, I do think at this stage, because we talked about this a couple of weeks ago, I think, in one of the podcasts, the difference with Stuart, the difference between accumulating assets and decumulating. And the thing about this side, the accumulating side, it's actually not that difficult, and it is something that you can probably manage yourself unless you've got extremely complicated personal life. And it's only whenever you come to start taking the money out that it starts to get a bit more, there's the sensitivity of various things goes right up, like when you take the cash out and the cash flows and sequencing risk and all that stuff. But the savings side, as long as you can be bothered setting aside a day every 3 months or so to kind of make sure that you're up to date on what's going on with your portfolio, is pretty manageable for a normal person, I think.
Well, the only thing I would say to that is that Kevin does say, I find this stressful. And one thing I wanted to say is actually, do you know what? It is stressful. It is stressful. Investing money, having money, worrying about money, it is stressful. And there's no getting away from that. And if you find it particularly stressful, then you should hire a wealth manager to do it for you. You know, that you can offload that responsibility onto somebody else. It's going to cost you, but you can do that, and you can do it cheaply. There are online wealth management companies now that can manage this for you. You can do it expensively by actually having, you know, a person who'll buy you lunch at Christmas and talk to you about it a lot. There are different ways to do this, but if you find having money and managing money keeps you up at night, get someone else to do it.
Yep, that's absolutely fair. And try and make sure it's a kind of a fee-based manager.
A flat fee-based manager rather than a commission-based manager, do you think?
Yeah, rather than, you know, percentage of your money.
Do you know what? I think this is a completely different podcast, or it's an extension podcast. So over the next month or so, we will do a Merryn Talks Your Money podcast on wealth managers online and not online, and we'll discuss that more thoroughly. So Kevin, listen out for that one. Anything else, John?
No.
We're kind of hoping to meet you now, Kevin. Dinner? Thanks for listening to this week's Merryn Talks Your Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Sam Asadi, production support from Moses Andam, and sound design by Blake Maples. Questions and comments on this show and all our shows always welcome. Our show email is merrynmoney@bloomberg.net, and that is the same address that I want you to send your number into.